So over here we have the market values of the land and building respectively. We have 260 for land, 240 for building, for a total of 500. So using this total of 500 of market values, we allocate how much of the purchase price should go to each asset. The 260 over 500 for the land gives us 52%, 240 over 500 for building gives us 48%. Then we can multiply by the purchase price. So 450 was paid. 52% times 450,000 will give us 234,000. And then we do the same thing down below. 48% times 450 again will give us 216,000. And then just for confirmation, we'll add 234 and 216 together, and we will get, of course, the purchase price paid. So this will go on Krista's books. Two assets will go on her books as 234,000 of land and 216,000 of building. Now we're ready to go ahead and make the journal entry. October 1st, debit land for 234,000. Debit building for 216,000. And then we of course paid with cash. Krista paid with cash of 450,000. Okay, there's a journal entry all done. Krista make this entry, and the land and building is now on her books. The cash is off her books. Betterment. When money spent on a capital asset improves the asset in a meaningful way. Example, increased capacity and/or efficiency, extended useful life. Betterments are debited to the asset account. They're amortized over time with the asset. So for betterment, you're doing something significant. You're changing the way a machine works. It can now do something else in addition to what it used to do. You're significantly extending its useful life, right? Something like that. Repairs. When money is spent on a capital asset to maintain the asset in working order. Repairs are expense, but not necessarily all at once. Recall that the matching principle states that we must match revenues with expenses. If maintenance is done on a work truck once a year, only 1/4 of the annual maintenance expense is included in the quarterly income statement. Another appropriate and possibly more accurate way to allocate maintenance expense is by repair costs per kilometer driven by the truck. So we'll talk more about this idea later. A closer look at amortization. Recall that we looked at amortization briefly in Chapter 3, specifically straight line amortization. Let's make some key points about amortization. And recall that amortization and depreciation are the same thing, interchangeable words, so you can go with the one you prefer. You will hear me use both of them in this chapter and in this course. Amortization is not a process of valuation. Businesses do not amortize assets based on their market value. Amortization is always based on an asset's actual cost. So you might have an asset which goes up in terms of market value over 5 years or 10 years. That does not mean that your books will reflect that value. Rather, you'll likely have the asset going down. might have bought it for 200,000 and the books might show the value as 150,000. Meanwhile, the market value might be 250,000. So amortization does not reflect an asset's valuation. Amortization does not mean that businesses set aside cash to replace assets once they're fully amortized. A business can choose to have a cash fund for asset replacement, but amortization doesn't measure or report this in any way. Amortization is sometimes related to physical wear and tear. As I mentioned the truck earlier, with the exception of land, physical wear and tear plays a factor in the amortization rate of many assets, cars, buildings, and equipment. Amortization is sometimes related to obsolescence. Some assets are simply amortized because of expected obsolescence. A computer is a good example. These type of assets may be physically fit for longer term use, but efficiency may be improved by upgrading regularly. So think about a cutting edge technology company. They might have high end computers being purchased at the beginning of every year, and they might have a policy where after 1 year, everything inside their lab is replaced. So those computers are still perfectly fine for 99% of the population. Some will get a good deal on it by buying them used. But for that company, they simply want to do cutting edge work. So an old computer is obsolete to them. So they'll sell it for whatever they can and get a new computer. Measuring amortization. Amortization is based on three factors about the asset: the cost, the estimated useful life, and the estimated salvage value, also called residual value. An asset's cost minus the salvage value is called amortizable cost. Three methods are commonly used in Canada to calculate amortization. We have straight line, units of production, and declining balance. More specifically, double declining balance, what we'll do in this class. Straight line is the simplest amortization method, which we've already seen several times, because it allocates an equal amount of amortization to each period of asset use. We covered this method earlier in Chapter 3. The equation for straight line amortization is cost minus salvage value divided by estimated useful life in years. So up top, you have cost, which you know. Salvage value is an estimate. So you can say the amortizable cost is in the numerator. In the denominator, we have another estimate, how long the asset is going to last. You'll note that it says years in this formula. That's the most common um, measure used. You can also have months or whatever in the denominator. So if you want to record amortization quarterly, you'll divide by the number of quarters you think the asset's going to last. For review, let's assume that Ch10 Bookstore uses the straight line method for its new desktop computer purchased on January 1st. The computer cost $900 with a salvage value of $100. It is expected to last 1 year, and the bookstore makes amortization entries right before each quarterly reporting period. What is the quarterly amortization expense for the computer? And we also have a journal entry to record this quarterly amortization expense. Take a minute here and try that. Continue here in the same video. Okay, so you should get amortizable value of 800 up top, 900 minus 100 salvage value, and then you should have 4 quarters as your denominator. Therefore, you should get $200 per quarter. So I'm making the first quarterly amortization entry. So remember that for accumulated amortization, you want to label what it is because it goes on the balance sheet as a contra account below the asset. So March 31st will be the end of our first quarter. We debit amortization expense, credit accumulated amortization computer for 200. I'm going to write a brief description. You can go ahead and do that. I would suggest maybe writing down your calculation if you feel like. 900 minus 100 divided by 4. Note that the amortization rate is 1/4, 1 divided by the number of amortization periods. We can make a straight line amortization schedule to present the asset, being the computer, being written down over a 1-year time frame. So this is pretty straightforward to fill in. You're essentially following what's happened in the first row here. So we had the purchase of the asset on January 1st. The asset book value is 900. Then we have a quarter for every 3 months. So we have the asset, or we expected to have the asset, times the amortizable cost, which is 900 minus 100, salvage value. So you get quarter times 800 gives you 200. And this is the column where your amortization adds up. So it's 0 when you first get the asset, now it's 200. So it's going to go up from here. Each time you amortize for 200, you add this column here. And this one is just your asset book value. So if you take 900 minus the latest number in this column, you get 700. Next time it will be 900 minus this number, and it will give you another number here. So take a few minutes to try this, and we'll go over it in the next video.